Overseas investors making bets against the United States have been a topic of increasing interest and concern in recent years. These bets, often involving short selling of U.S. assets or betting on economic downturns, raise questions about the factors driving such investment strategies. Overseas investors sometimes worry about the way the U.S. manages its money. They get concerned when the U.S. buys more stuff from other countries than it sells. This creates something called a trade deficit, which means the U.S. owes more money to other countries. Also, the U.S. borrows a lot of money, which is called national debt. These things can make the U.S. economy seem weak and not so stable. For example, when a country keeps buying more things from other countries, it may end up with lots of money from other places. In this case, investors from other countries might think that the value of the U.S. money will go down soon, so they start making bets that the U.S. dollar will become less valuable. China is one such country that has given this a lot of thought. It has invested a lot of money in U.S. Treasury bonds, which are like IOUs from the U.S. government. But China is worried about how much the U.S. dollar is worth and also about its own money from other countries. Because of these worries, China has thought about investing its money in different things, not just in the U.S. So when investors from other countries, like China, start worrying about the value of the U.S. dollar and their own money, they might decide to bet against the US dollar. This means they're making a guess that the US dollar will become less valuable in the future. Overseas investors pay close attention to how much money costs in the United States and how much the government manages it. The US Federal Reserve, which is like the money manager for the country, can change how much it costs to borrow money by raising or lowering what's called interest rates. These changes can have big effects on money all over the world. When investors from other countries think the interest rates might go up, they might make bets that the prices of certain things, like US bonds, will go down. This is like making a guess that the value of these things will drop because it becomes more expensive to borrow money. This way of making bets is called shorting. In 2013, the Federal Reserve talked about reducing the amount of bonds it was buying. This is known as tapering. Many investors from other countries, especially those in developing countries, got worried. They were afraid that if the Federal Reserve stopped buying as many bonds, interest rates might go up, and this could lead to a situation where people started selling off their assets, causing their prices to fall. So, to be safe, these investors started selling their U.S. assets, like bonds and stocks, to protect their money from potential losses. This move by the overseas investors was their way of preparing for a situation where borrowing money becomes more expensive. When this happens, it can affect not just the United States, but also many other countries around the world. So, investors have to keep an eye on what the U.S. and the Federal Reserve is doing, because its decisions can have a big impact on their money and investments. Geopolitical tensions and trade disputes can make big investors from other countries feel unsure about investing in the United States. When there are fights between countries or when trade policies become more protective, it can create problems for the economy of the United States. Investors might worry that these problems could make things worse for the economy and the stock market, so they might try to protect themselves from any bad effects. For example, in 2018, there were big tensions between the United States and China about their trade. This made some investors worry that there might be less trading between the two countries, which could slow down the global economy. Because of this, some investors changed what they had invested in to be ready for any bad things that might happen to the United States economy. When investors make these kinds of changes, they're trying to be careful and make sure they don't lose too much money. They want to make sure they are ready for any difficulties that might happen because of problems between countries. Sometimes people from other countries think that things in the United States, like stocks or real estate, cost too much. This means they believe these things are not worth as much as people are paying for them. When this happens, these people might take actions like betting that the prices of these things will go down. This is called a short position. They might also decide not to put as much of their money into the United States to keep themselves safe if the prices go down. A long time ago, there were 2 times when people thought things in the United States were worth too much. One time was in the late 1990s when many people were very excited about the internet and invested a lot of money in internet companies. People thought these companies were worth a lot more than they really were, and this made prices go very high. Another time was in the mid-2000s when a lot of people were buying houses, even though they were very expensive. This made the prices of houses go up a lot. People who were not from the United States saw that these prices were too high, so they were careful and did things to protect their money in case the prices went down. Diversification is like not putting all your eggs in one basket. It means spreading your money across different types of investments so that if one investment doesn't do well, the others can make up for it. Overseas investors, who are people from other countries investing their money, may bet against the US not because they think something bad will happen, but to make their investments safer. Imagine if you have some money in the US stock market, but you're worried it might go down. You might also put some money in things like gold or the Japanese yen, because they often do well when the US stock market doesn't. This way, if the US stock market goes down, the gold or yen can help balance out the loss. It's kind of like having a backup plan. The financial crisis of 2008 was exacerbated by a negative feedback loop where investor panic led to further declines in asset prices. Many overseas investors took bearish positions during this crisis, anticipating that the market turmoil would continue. During 2020, when the COVID-19 pandemic caused a big problem for the world's economy, some investors from other countries were worried that the United States might also face a hard time. They thought that there might be a recession or a big economic downturn. They looked at different signs that showed the economy was not doing well. When they saw these signs, they decided to do something called short selling or betting against US stocks. This means they were making investments that would do well if the US stock market went down. They did this to try to protect their money from possible problems in the economy. They wanted to be careful and make sure they wouldn't lose too much money if things got worse. Overseas investors who hold US assets face currency risk. Changes in exchange rates can significantly affect the returns on US investments when converted back to the investor's home currency. To manage this risk, investors might use derivatives or other hedging strategies, effectively betting on currency movements. European investors holding US assets may employ currency hedging strategies to protect against fluctuations in the euro-dollar exchange rate, thus mitigating currency-related risks. Political events and policy changes in the US can drive overseas investors to bet against the country. If investors perceive that political decisions or changes in leadership could adversely affect the economy or markets, they may adjust their positions accordingly. The uncertainty surrounding the outcome of the US presidential election in 2020 led to concerns about potential policy changes. For more such videos, like, share, and subscribe to the channel. And what do you think? Why are overseas investors investing against the US? Let us know in the comments.